Welcome to this session on helping you profile the white-collar criminal. I hope you find this information informative and of value in helping you manage the risks of fraud within your organization. Hello, my name is Craig Greene, and I'm a founder and current managing partner of Greene Forensic Accounting Solutions, LLP. GFAS specializes in providing forensic accounting services to law firms, business enterprises, governmental units and agencies, not-for-profit organizations, and individuals. I've been a practicing forensic accountant for over 30 years. I hold an undergraduate degree in accounting and obtained a Master of Criminal Justice degree. Over the years, I've had the pleasure of being an instructor in fraud examination and forensic accounting for the Association of Certified Fraud Examiners, the Institute of Internal Auditors, other professional organizations, as well as colleges and universities. I am assembling a wide range of instructional presentations to be uploaded here on YouTube and my firm's website to help you, the owner-manager, identify potential fraud and embezzlement within your organization. In this session, I want to focus on identifying the characteristics and warning signs, red flags as we call them, of the occupational fraudster. It is my hope that armed with this knowledge, you can reduce the risk of fraud in your own organization. To begin our discussion, I focus on the ACFE's most recent study on occupational fraud and abuse, and specifically what the study found with respect to the occupational fraudster. You will find the study provides a great amount of details and statistics concerning who within your organization is most likely to commit fraud. I then want to focus on the theories postulated by criminologists concerning the white-collar criminal and why they do what they do, and their explanations on crime causations. We will then turn our attention to one of the most important parts of this presentation. We will discuss a list of red flags, warning signs to look for within your organization. I will then end the presentation with a discussion of one of my most admired occupational fraudsters, Ben the tax accountant. I'm sure you'll enjoy the story. The Association of Certified Fraud Examiners is the world's largest anti-fraud organization and a provider of anti-fraud training and education to forensic accountants and others. The ACFE, founded in the mid-1980s, has more than 85,000 members and conducts the largest study of occupational fraud in the world. This study has consistently found for years that organizations lose approximately 5% of their annual revenues to fraud, waste, and abuse. To put that into perspective for your organization, simply multiply your revenue or sales or financial support by 5% to compute the potential amount of occupational fraud that exists within your organization. This amount translates to approximately $4.5 trillion in fraud losses each and every year in the world. The average loss in this study was $1.5 million, with a median loss of $125,000. It also found that frauds lasted a median of 14 months before being detected. So let's discuss what sort of person commits fraud. Is it someone with a shifty appearance, in need of a shave and a haircut, black shirt, white tie, sneering glare, low-cut blouse, too much makeup, and big hair? Fraud perpetrators tend to be the least suspected. When I teach this session as a live seminar, I say look to your right, then look to your left. What does an occupational fraudster look like? Well, in this case, why don't you just go ahead and look in the mirror? They look like you and I. So let's focus on the perpetrators. What do we have to be careful with? Those perpetrators with more authority. Could be your business partner, your trusted manager, or your favorite employee. The more authority an individual has, then the greater access to resources, as well as possessing the ability to override the internal controls that the organization puts in place to mitigate its risks. Secondly, trust is a factor. The more trust the organization has in an individual, the more autonomy and authority the person has, which results in more opportunity to embezzle from the organization. Based on my experience, embezzlement is a crime of opportunity. That being said, organizations are like pyramids, bigger at the bottom and smaller at the top. So looking at the number of frauds, we find that more frauds in sheer quantities are committed by employees, but the sheer size and the amount of the theft increases significantly with the person's position. This diagram illustrates my previous point. The ACFE study has found that the median loss for owners executives of occupational fraud is $600,000. That is 4 times the median loss of a manager at $150,000 and 10 times that of the employee at $60,000. The study found that frauds committed by higher level perpetrators take longer to detect. That would make sense, as higher level perpetrators often have the ability to override internal controls, as well as intimidate those that might identify the wrongdoing. Interestingly enough, tenure has no strong correlation with embezzlement. In fact, I've worked on several cases where the embezzler went from company to company. The losses increase the longer the perpetrator has been with the company. Of course, as we discussed, the higher the position within the organization, the larger the loss. The study did conclude that the longer a fraud perpetrator works for a company, the more damage the person's scheme is likely to cause. One of the other consistent findings we always see is that only a small percentage of fraud perpetrators have been previously convicted of a fraud-related offense. I suspect that this is a result of many companies not prosecuting embezzlers. In fact, the study showed that 41% of the frauds in the study were never reported to law enforcement, and also concluded that the true number of repeat offenders is probably higher than what can be determined through criminal records. Although parity is slowly coming about, males still commit more frauds than females. In my experience, many of the accounting frauds I see are female accountants and/or bookkeepers. As you can see, the median losses caused by male perpetrators is nearly twice that of females. I suspect that is because males still dominate the higher positions within an organization. As to age factors, more than half of all frauds are committed by individuals over the age of 40. In my opinion, that makes sense, as individuals at that age have a lot of financial pressures, such as college tuition for the children, keeping up with the Joneses, and in some cases marital discourse. 1/3 of the fraud perpetrators are in that 41 to 50-year age range, and 1/3 are also in the age range of 31 to 40. As one would expect, the higher the education level, the higher the loss. Typically, those with higher education levels occupy higher positions, and as we previously discussed, giving them more authority, more autonomy, and of course, more trust. This is an interesting slide as it depicts what percentage of cases are by department. For years now, accounting has occupied the #1 spot, which makes sense because that is often who controls the money. That has changed in this most recent study, with operations now in the #1 spot. As you can see, the most likely fraud scheme used by accounting, however, is billing schemes. And then following accounting is the executive and upper management schemes, sales schemes, and customer service, and then finally administrative support. I suspect that cashiers fall under customer service. The study asked the respondents to list the behavioral red flags that were included in the cases they investigated. The #1 red flag for years has been living beyond one's means. That is followed by experiencing financial difficulties. In my experience, I think there are individuals that are moneyholics. They simply spend more than they make and cannot control themselves. It is not unusual in our examinations to find that the subjects had previously filed for bankruptcy protection. Unusually close association with a vendor or a customer is a common red flag we see in corruption cases, such as bribery and economic extortion. Control issues is also a common red flag. The occupational fraudster does not want to share duties, as they are concerned that they may be found out. Also, it is not unusual for occupational fraudsters to handle more work so they can have more places to try and hide their frauds. You may find that they have a wheeler-dealer attitude and enjoy gaming the system. The fear of being caught often leads them to irritability, suspiciousness, or defensiveness. In my experience, it is not unusual for successful executives to leave an old family and begin anew. The issue is that often the first family receives a lot of the then accumulated family wealth. This results in the executive having to steal from the organization to provide a nice livelihood for the new spouse and family. Other issues we see include addiction problems, such as gambling, alcohol, and drugs. Finally, in my experience, look for people who are overqualified for the job, refuse promotions, and refuses to take time off for vacations and the like. Let's now turn our attention to some criminology concepts. Criminologists study why criminals do what they do and postulate theories of crime causation. The first theory I would like to discuss is the one postulated by the father of white-collar crime study, Edwin Sutherland. Sutherland was the first criminologist to coin the term white-collar criminal. His explanation of white-collar crime is called the differential association theory. He postulated that criminal behavior was learned from others in the organization, and that the perpetrator makes a calculus of how likely he is to get caught. More recent criminologists have dwelled on the influences of mass media on us as a society. The emphasis on success. Television and movies show us large homes, beautiful and handsome spouses, expensive imported autos, and a successful lifestyle. This is also known as the American dream. Unfortunately, there are individuals and groups who are unable or unwilling to pursue the legitimate means to obtain these items because opportunities are blocked or made difficult for their use. The rationalization variable was postulated by Donald Cressy, a student of Sutherland with an interest in embezzlers and white-collar criminals. He interviewed for his doctoral thesis approximately 1,000 embezzlers that was used for his classic treatise entitled Other People's Money. Cressy was professor of sociology at the University of California, Santa Barbara. Cressy was also a close friend of Joseph Wells, the founder of the Association of Certified Fraud Examiners, and his theory of crime causation has been adopted by the association. Cressy stated that individuals would get themselves into a financial crack, as he called it, a non-shareable financial problem. The individuals knew that they could solve their problem by stealing from their organization, and they possessed the knowledge and access to embezzle. Cressy also postulated that all criminals, no matter how heinous, had to rationalize their acts. As I said before, Wells and Cressy were friends and professional colleagues. They worked together during the inception of the Association of Certified Fraud Examiners, and using Cressy's hypothesis, developed what's now termed the fraud triangle. The fraud triangle consists of three parts, the first being a non-shareable financial problem. This includes such things as marital problems and affairs, addictions such as gambling, drugs, alcohol and spending, business reversals, and health care bills. The second element is rationalizations. Rationalizations can be such things as, the company does not pay me enough. I'm not hurting anyone. It is a victimless crime. The company can afford it. Finally, the occupational fraudster must be in a position of opportunity to commit the crime. That is, have the knowledge to embezzle and the access to the organization's assets. So let's review. These are the most important red flags to look for within your organization based on my experience. Number 1, unexplainable wealth. Number 2, refusal to take promotions. Number 3, refusal to take time off. Number 4, unusual hours and or taking on of additional work. Number 5, doing jobs below their position or taking on others' responsibilities. Number 6, addictive behaviors such as alcohol, drugs, and gambling. Let's now turn our attention to a real-life case of mine from back at the turn of the new millennium. My story here is about Ben. Ben is my all-time favorite embezzler, so let's talk about him to bring us back to real life. Ben was a tax accountant for a subsidiary of a $7 billion corporation. Ben had been with the company for over 28 years, holding the same position after spending a mere 18 months with the company. Ben's scheme was discovered when a tip was called in to the company's general manager from its bank's fraud unit. The caller told the general manager that over the past several months the unit had been tracking some unusual deposit activity. Company checks payable to the bank in the amount of $7,500 were being deposited into an account in the name of Emily's boutique store that was located in an upscale suburb. The general manager knew that Emily was in fact Ben's wife. He then proceeded to call Ben into his office, taking Ben's briefcase with him, wherein he accused Ben of theft of company funds. During his interrogation, he opened the briefcase, and what did he discover? Well, he found a number of uncashed customer checks, but more importantly, he found a loaded .45 caliber handgun. This is one of the reasons why we advise our clients not to do their own investigations. Not being trained investigators, they may spoil the evidence, or worse yet, have someone become physically assaulted, hurt, or even worse. Fortunately, Ben did not use his handgun. Ben had told the company that they had to make weekly estimated tax payments for diesel fuel tax in the amount of $7,500 payable to their local bank. The facts were that the company was an end user of diesel fuel, and the tax was included with the supplier's invoice. Further, the state did not require weekly estimated payments, nor were the state tax payments processed by the bank. Payments would have been made directly to the Department of Revenue. Finally, Ben told the accounting staff to give him the weekly checks so he could ensure that they were properly credited at the bank. It was found that Ben was including the tax checks in the company's COD deposit. Since Ben had to go to the bank with the weekly tax payment, he was also in charge of taking deposits to the bank as well. So let's talk about how Ben's scheme worked. Accounting would give Ben the daily COD deposit. He would then extract a combination of cash and checks equaling $7,500 and insert the company tax check into the deposit in order for it to balance. The next day, Ben would remove some more cash and place some of the removed customer checks from the previous deposits in its place. Over time, it is my belief that Ben had a large number of odd undeposited checks, and he was becoming concerned that they would become stale dated or customers would start questioning why their checks had not cleared. So beginning in January, he began depositing the tax checks into his wife's boutique store instead. This was the change in his modus operandi that led to his detection by the bank's fraud unit. So let's talk about the red flags that management missed. Ben lived in a very expensive home in an affluent suburb, though he never made more than $65,000 a year during his time with the company. In looking at the payroll records, Ben had the second most unused sick, vacation, and personal time available. He was offered the position of company controller years ago, but refused to take it. Clearly, he couldn't afford the cut in pay. In fact, this is one of the most common red flags to look for. As you recall, Ben had worked for the company in the same position for 28 years before his detection. Based upon our examination, we're not certain exactly when his fraud began, but we had evidence that it spanned for at least 8 years, and the amount stolen was well in excess of $4 million. Fraud takes a lot of work, and Ben worked after hours and on weekends. Fraudsters often need to maintain separate accounting records of their frauds, manipulate the accounting records and documents, and of course, fear that their actions may be detected if done during normal working hours. Ben did have an explanation for his wealth. He told his fellow workers that his additional income came from a small sundry store that he owned inside of a local hotel. Well, I hope you enjoyed this presentation and that it enhanced your knowledge of potential risks within your organization. Please tell your colleagues about this video so that they can learn as well. In closing, if what we discussed today appears to be occurring in your organization, you need to call me. I can be reached via email at cgreenefforensicas.com or at 312-692-1000 for those calling from the eastern United States and 702-430-1779 for those calling from the western U.S. Thank you for attending, and do tell your colleagues about us. Have a great day.